Are you ready to make your money work without losing sleep? On this episode, we're talking stable income and smart risk management with Canada's top asset managers. Tune in today to see how Mulvihill's preferred shares ETF,
and you're also getting a nice uptick in yield relative to these other asset classes.
Skyline's resilient retail REITs,
Tier 1 grocers are reporting record profitability.
CMLS's mortgage funds,
We're big believers in taking a portfolio approach to all investment decisions.
and Harvest low volatility strategies can help you stay steady even when markets get rocky.
It almost seems like when markets would sell off, policy initiatives would soften, and we're calling that the taco trade.
Let's get you market proof fast. Welcome to the very first episode of the new BTV Spotlight series. Today, we're kicking things off with a guest who truly knows the ins and outs of innovative income strategies, John Mulvihill, President and CEO of Mulvihill Capital Management. Under John's leadership, Mulvihill has become a Canadian leader in structured products and split share solutions, helping investors navigate a landscape where safety and smart cash management matter more than ever. With markets staying somewhat uncertain and everyone hunting for better places to park cash, Mulvihill's split preferred share ETF has been getting some serious attention as a way to combine attractive yields with built-in downside protection. John is here to break down what makes these ETFs standout options for people who want more from their safe money, and explain why the hunt for safety and steady income is changing the way Canadians invest. Let's go straight to the source for some investor intel. What should investors consider when looking at preferred shares in Canada for portfolio stability?
One of the areas at Mulvihill that we've seen tremendous growth in is within the split preferred share space. So the split preferred shares have attracted a lot of interest because there's a buffer or sort of a known level with which there is an asset coverage that protects the preferred share. So when you're looking at a split preferred share product, there's a preferred and a Class A share. In order for that preferred share to begin eroding in value based on its net asset value, the Class A share has to be completely eliminated. So its net asset value has to go to zero. A very big buffer before these preferred shares start to absorb some of the losses.
How can diversifying into low correlation assets help investors during market volatility?
These historical asset classes like fixed income, like Canadian preferred shares, that have historically done well when markets have declined. As interest rates rise, that is bad for fixed income. It's bad for traditional preferred shares. And so you have this positive correlation all of a sudden with the equity market that is a little new for a lot of investors out there.
That's great. Can you tell me another reason why you think split preferred shares are the way to go?
You really do get this steady net asset value that has very, very low volatility over time. So you get this combination of low volatility, low correlation, and you're also getting a nice uptick in yield relative to these other asset classes, which really minimizes the drag in up markets or the opportunity cost of up markets from that allocation.
Okay, let's keep the momentum going as we welcome our next guest, Wayne Bird, Chief Financial Officer and Partner at Skyline Wealth Management. Wayne is not only a driving force behind Skyline's nearly $9 billion platform, but also a recognized leader in private real estate investment and financial strategy. Did you know that even with everything that's going on in the world these days, Canadian grocers are actually seeing record profits, with top players noting more confident shoppers? It might seem counterintuitive, but that's what Skyline Wealth's CFO and partner, Wayne Bird, is reporting to us. Let's dive into the fact that essential retail is still strong in Canada and within the Skyline portfolio.
Tier 1 grocers are reporting record profitability, which reinforces the strength of everyday needs-based retail. We see recent earnings reports as strong confirmation of the ongoing resilience of essential retail in Canada. and they align very closely with what we've seen across our portfolio.
So what trends led up to this, Wayne?
In May 2025, Loblaw companies reported revenue growth of 4.1% and a 9.3% increase in adjusted earnings per share, reinforcing the notion that consumer demand in this segment is not only holding steady, but growing steadily.
So how does this trend impact the Skyline REIT?
At Skyline Retail REIT, nearly 80% of our base rent comes from essential retailers, many of which are Tier 1 national brands, and all of whom are showing strong financial results and consistent consumer traffic.
This is such great information. What sort of revenue are you reporting then?
Skyline Retail REIT reporting revenue growth on leases that expire and renew was over 10%, a record for the REIT and 35% of our previous record. So these earnings are more than just strong headlines. They're reflective of the real sustained performance we're seeing in essential retail.
So explain how grocery-anchored retail centers stayed strong in 2025, and what can investors take from that?
Even as broader market conditions remain uncertain, their performance has been underpinned by consistent demand, stable tenancy, and evolving consumer behavior that continues to favor essential retail formats.
Discover investment opportunities for your portfolio from the experts. Thanks, Wayne. And welcome to our next guest, Adam Dean, Vice President and Portfolio Manager at CMLS Asset Management. Adam plays a key role in overseeing CMLS's suite of mortgage funds and alternative strategies, giving him a front row seat as to how alternatives are reshaping the investment landscape. He'll also share his perspectives as to why alts are becoming an essential piece of modern portfolios, and how CMLS approaches risk and opportunity in the mortgage space, and the trends driving demand for these innovative solutions. In today's economy, how should investors approach capital preservation across asset classes?
We're big believers in taking a portfolio approach to all investment decisions, and that means making individual investments in the context of your broader portfolio. Investing in debt, whether public or private, secured or unsecured, is limiting downside risk or exposure to losses in income or declines in asset value before your capital is at risk. If you can find a combination of good current income or compounding yield and that downside protection, these investments can play an integral part in all portfolios.
With rising market swings, how can alternatives like mortgage funds help reduce portfolio correlation?
In private markets, valuation is a choice, and we happen to choose to value our investments monthly, consistent with how often we let our investors trade in and out of the portfolio, as we believe this is the fairest outcome.
That's interesting. Tell me more.
Debt benefits from an equity cushion to absorb changes in market value. So when property prices go down, the value of our mortgages aren't immediately impacted, as we still expect to receive all contractual cash flows from that investment. Second, our portfolio is short duration, so movements in market yield have a muted impact on the asset value of the underlying mortgages. And finally, we are an open-ended fund, so buy or sell pressure doesn't affect the price of our fund the way it would a stock, let's say, with a set float or supply being traded. The historical result for the CMLS mortgage fund has been limited fluctuations of NAV within a few cents around $10 and consistent positive monthly returns.
So for income-focused investors, how does CMLS deliver steady monthly payouts, and what should they look for in a consistent fund?
With short duration investments, having a steady stream of investment opportunities to replace those investments being repaid is incredibly important. Being connected to Nesto and CMLS, who collectively transact over $20 billion of mortgages annually, provides the CMLS mortgage fund with that steady flow of investment opportunities. So rather than target a specific percentage yield for our investors, we target a spread relative to other fixed income investments available in the market.
What about 10-year returns?
We've delivered approximately 3% greater than a diversified portfolio of short-term investment-grade bonds with similar credit performance throughout. What this allows us to do is maintain a consistent risk profile for our investors rather than change that risk profile in pursuit of a specific percentage return.
Get ready for an insightful conversation as we welcome Paul McDonald, Chief Investment Officer at Harvest ETFs, a leader in innovative portfolio solutions. How would you describe the current economic climate, and what are the biggest risks facing investors today?
It's surprising how strong the U.S. economy has been despite these ongoing global geopolitical issues and very meaningful trade disputes. Policy tensions have eased a little bit. These risks, though, especially ongoing conflicts Mideast and in Europe, political unpredictability through the U.S., these can cause very sudden market gyrations.
With heightened market volatility, what strategies are you seeing clients gravitate towards for portfolio protection?
Well, first, I think markets have become less reactive to some of the policy and geopolitical headlines post-April. It almost seems like when markets would sell off, policy initiatives would soften, and we're calling that the taco trade. It's led to a major shift in what's working in the market. Areas tied to economic growth like mega cap tech, they've rebounded and really are leading the way since April.
How do you think recent central bank and geopolitical events are influencing investor sentiment and market behavior?
Another area that we see performing very well right now is in Canada. It recently hit all-time highs again, and so Canada has some great companies, and I'd even say some great oligopolies that generate big cash flow. And so one style we've seen people gravitating to now is a portfolio of stocks that exhibit low volatility metrics. It's kind of a way to get invested, being diversified in some leading companies.
What role do you think low volatility strategies should play in a diversified portfolio, especially in today's environment?
So as I mentioned before, diversity by sector is really important, but also different styles can work at different times. So for Canadian investors looking at this approach, we've got a couple options at Harvest, the Harvest Canadian Low Volatility Equity ETF, HVOL, or the Harvest Canadian Low Volatility Income ETF. So with better sentiment and kind of more meaningful risk clouds still lurking, it's a way to be invested in some of our Canadian leading companies, but perhaps exhibit a little bit less volatility than the markets, and that remains core at the portfolio construction.
Subscribe to get notified when our next episode drops. And until then, happy investing.